Tim McClone, MB Invest, currently finishing up meetings in Lake Tahoe, Nevada. Today I want to talk about the Federal Reserve raising interest rates. So the Federal Reserve raised interest rates by 1/4 percentage point Wednesday. It's the 8th increase in less than a year as the central bank continues its crackdown on inflation. Of course, this all ties in with inflation, unemployment, and the broader economy. The Fed goal is to bring inflation back down to 2%. That's their goal. My opinion, expect ongoing increases in quantitative tightening. Keep in mind, January inflation rate will be released February 14th, Valentine's Day. So the hike in the Fed's benchmark rate is the smallest since last March and signals that the policymakers are shifting to a more maybe cautious approach after spending much of last year playing catch up and boasting borrowing costs at the fastest pace in decades, ladies and gentlemen. So when we talk about consumer spending has cooled in recent months and inflation has dropped significantly, although prices are still climbing faster than the central bank would like. So I'm concerned about this January inflation rate. You know, why? Because when we talk about gasoline prices haven't been going up all of January. Commodity prices have been going up, as well as, the labor market still remains tight. I don't care what anyone says. Food prices are out of control. Food prices have risen more than 10% over the past year. We have an egg shortage in a first world country. Shouldn't be happening. Very, very interesting. That's a topic for another day. So, egg prices alone have gone up over 60%. Butter is up more than 31%, and lettuce has jumped 25%, and that's according to Labor Department data. And that's through December. So gas prices were, ticking lower towards the end of 2022, but have, propped higher in recent days, hitting $3.50 a gallon nationally for an increase of about 30 cents over the past month, according to AAA. So I think it is going to be very difficult for inflation to come down, bigger jumps going forward. Fed officials, they're just throwing shit at the wall. Fed officials have remained, resolute about tackling inflation, though they have said recent numbers show pressures could be easing. The consumer price index declined 0.1% in December on a monthly basis and is up 6.5% from a year ago, down from the peak of 9% last summer, but still well above where the Fed feels comfortable. So when you this all goes hand in hand when we talk about what the Fed's bond buying. So along with the rate hikes, the Fed has been reducing the holdings in its bond portfolio. I've talked about this before. This has resulted in a reduction of about $445 billion since June, as the Fed has targeted a cap level of $95 billion in maturing bonds. It is allowing to roll off each month rather than reinvest. Let's try to get that balance sheet down, guys. So the balance sheet reduction has been the equivalent of about 2 percentage points of additional rate hikes, and that's according to the San Francisco Fed. The balance sheet, folks, is still at more than $8.4 trillion. Atrocious. So, they said they're going to be cautious about declaring victory and sending signals that we think the game is won. Ladies and gentlemen, the game is far from won because, they have a long way to go. And that's, at least Jerome Powell said that. He told reporters. So while the prices of some goods like new and used cars has started to fall, the Fed is concerned that the price of labor-intensive services may continue to climb. That would make, folks, it harder to get inflation back down to the central bank's target, as I said earlier, of 2%. Good luck. I'm an optimistic guy, but I mean, right now the markets don't see eye to eye with the Fed, and that's what I'm seeing. On average, the Fed policymakers said in December they expect their benchmark interest rate to climb to 5.1% from 4.625% now and remain there at least through the end of the year. So I think, from all the readings and learnings and conference calls I've been on, the financial markets are skeptical of that forecast. Many investors are betting that the central bank will soon start cutting interest rates, despite repeated warnings to the contrary from the Fed officials. The expectation of lower borrowing costs is one reason the stock and bond markets have rallied in recent weeks. So the S&P 500 index rose 1% on Wednesday, while the NASDAQ jumped 2%. So when will interest rates fall is the big, question, the 800-pound gorilla in the room. Investors, on these calls that I've listened to, investors broadly expect the Fed to stop rate hikes as the economy slows. Most analysts expect just one more rate increase to a top range of the 5%, and many think the Fed will actually cut rates this year as the economy enters a mild recession. We've had 2 consecutive quarters of negative growth, 10 plus times since World War II. It's always been a recession. We're in a recession right now. So the long-term fiscal challenges facing the United States are serious, ladies and gentlemen. Significant borrowing was, somewhat necessary to respond to the COVID-19 pandemic. However, the structural imbalance between spending and revenues that existed before the pandemic is still large and will grow rapidly in the future. Furthermore, as interest rates rise and the nation's debt, and this is very concerning to me, grows, it will become even more expensive to borrow in the future. Congresses, if you look at this, Congresses and presidents of both parties over many years have avoided making hard choices. And I've talked about this extensively. They just kick the can down the road. They don't want to make the hard choices about our budgets and fail to put they fail to put the budget on a sustainable path. It is vital for lawmakers to take action on the growing debt to ensure a stable economic future. Our leaders refuse to spend within their means, instead running up multi-trillion-dollar deficits and printing trillions of new dollars. All this money, folks, is going to have to run off. We got, crushing price increases as a result, and we're also going to face trillions more in taxes and as interest rates rise and our debt becomes more expensive. In my opinion, all this could have been avoided, but, all we can do now is hold our leaders accountable, which a lot of people don't want to do. Maybe that's changing. So, we don't want this to happen again. Like I said, globally, you have 35 trillion printed. In the United States, people think things are going to get back to normal in 6 months. All this money needs to run off. All this printed money. We're in for some pain. And the Fed does not know what they're doing. I appreciate the effort, but you have to be skeptical of the Fed, and the markets are showing that. So that's where we're at right now. Next one coming up, February 14th, Valentine's Day. Take care. Talk to you soon.